the Growing Your Own Money podcast. Dean Thorpe, a CEO and financial advisor, and his son James Thorpe, a social media marketing business owner, sit down and discuss all things to do with money, goals, business, and the markets.
Here we are.
Indeed. Back from a summer break.
Yes,
Been a little while, hasn't it?
it has indeed.
Yeah. Been up to plenty of holiday, plenty of.
Yep, bit of a break, bit of work, bit of business.
Yeah. So today, I thought we'd jump straight back in and look at a term called a bear market.
Right.
Now, obviously, in investing, that's often a term you don't want to hear, or maybe in some cases you do want to hear it if you're looking for buying opportunities.
Yeah.
But I thought we'd discuss bear market, some strategies to sort of see your way through a bear market, and sort of how you recommend people go through that process. So just to start off with, tell us what is a bear market?
So technical terms, you've got a bear market and a bull market, and both ways it's a change in prices of 20%. So when you're in a bull run, the markets are flying and you're enjoying good growth, it's a consecutive sustained period of 20% or more of growth over a relatively short period of time. And then the reverse is true for a bear market. A bear market is when you see a fall in prices generally of more than 20%. Now typically with the world stock markets, the bull runs, the periods of growth that we experience tend to be stronger and longer than the periods of a bear market. So you might get a run over a period of 5 to 10 years of in excess of 50% over that period of time. In some cases you could double your money depending on where you're invested. By the same token, a typical bear market will be relatively short-lived, so you're talking 1 to 2 years of more than a 20% drop. You might see as high as a 40 or 45% drop over that period, but then of course a longer, stronger, sustained recovery in the bull market completely reverses that drop.
Yeah.
Your challenge, so that's the technicality, if you like, for a bear market. That's the definition of a bear market, 20% drop or more. How do you deal with it is more to the point. The challenge with bear markets is, do I need access to my funds? So the only issue you've got dealing with a bear market is, do you need the money?
Yeah.
If you need the money, then you've got to look seriously at what have I got in cash, what have I got in low risk investments compared to what I've got in the assets that I've allowed or seen fall. And that's where we come back to something we've talked about before, where it's a good idea generally to keep between 3 and 6 months of your expenditure, not necessarily your income, but your expenditure readily available in some form of low risk or cash based investments. Absolute worst case scenario, you may want to borrow some money over a short period of time, so long as the rates are relatively low.
Yeah.
Don't go borrowing money at silly rates. If you feel you're in a situation where it's going to be a relatively short-lived bear market.
Yeah.
So the important thing to do in a bear market is just to reflect on the period that you might have had. It can be harder experiencing a bear market where you've relatively recently invested some new money. So if you put money in and immediately experience a drop, you're seeing your money, your newly invested capital immediately go negative.
Yeah.
Whereas if you've had a period of growth where you've seen some growth and then you go into a bear market, it's coming off the growth.
Yeah.
So psychologically and emotionally, that's a completely different experience. Because if you put £50,000 into a fund and it immediately drops by 5, your 50 is worth 45. But if you put 50,000 in your fund, you've had nice growth of say 10, 20%, it's gone up to 55, 60,000, then it comes back to 56, 57, you're still in the money, you've still got the growth.
Yeah.
And that is sometimes part of what you have to deal with emotionally, in the sense of, my money's gone down, I can't let it go down any further, I've got to pull it out.
Yeah.
And that's the kind of, that's the emotion that you're pulling against, and it's an instinctive emotion that you're pulling against. And the example or the analogy I often use is supermarket shopping for stock market.
Yeah.
You rarely buy more when the prices are rising. You don't buy as much at the supermarket, but the minute you see a 2-for-1 offer or some kind of offer because the prices are down, even if it's just on some fruit or some vegetables, just a special one-off thing, you might buy more of that because you see the price has gone down. And you know in your mind emotionally, in a supermarket setting, it's going to be for a relatively short period of time.
Yeah.
And it's about getting your head around that with stock market investing as well. When you see a dip in the market, a drop in the market, that's often an opportunity to buy a little bit more if you've got spare funds. And so this recent period that we've seen has been a potential buying opportunity because the prices of everything pretty much dropped over a very small period of time. We're talking weeks, if not just days.
Yeah.
And then you saw a swing back. So if you were positioned in such a way where you got money already in the market, but you'd also got some cash on the sidelines, you could have jumped in, so to speak, bought a little bit more, and you'd have benefited from that little dip in the market.
Yeah.
And the thing about stock market investing, when you look at the graph over a long period of time, say 10, 20 year period, these drops, these bear markets or just little bits of volatility become blips in a graph. So the graph looks like that in the short term, but in the long term it's almost a straight line going up with little ticks along the line. When you're in the middle of it, it doesn't feel like that. It feels like a big drop in the graph.
Yeah.
And that was most widely marked, if you look back to the COVID period that we had, post-March 2020, big drop in the market, government stepped in, big recovery. It's literally a V shape when you look at the graph narrowed in on a 3 or 5 year period.
Yeah.
But even on that period of time, if you extend it out to a 10 or 15 year period, you can still see the V, but it's a relatively small V compared to 3.
So all about extending your time horizon and looking and playing the long term game with your investments. And like I say, a good technique is to have a bit of money ready for when there's a dip, because it's inevitable, isn't it? There's always nothing ever goes straight up. There's always some kind of pullback. So I guess making sure you've got those funds available.
My philosophy is long-term buy and hold investing. There are still people in the markets today, as there have been for the last 100 years, that will speculate. They are speculators. So there will always be people speculating and attempting to either call the market, time the market, or just speculate on a particular asset. And that's where you get your volatility. And all that's really happened in this period that we've seen, and it's a very short-lived, short period of time, is that there was a little bit of bad news about the US at the beginning of August. Interest rates didn't fall in the US as the market expected.
Yeah.
And so you then saw something called government borrowing, gilt yields spike a little bit. And some of the speculators in relatively recent past, so we're talking the last year or two while interest rates have been low, they've been borrowing money to invest. But they've gone a little bit more specialist than that in terms of speculating. They've actually borrowed in a different currency to the one that they've invested in.
Yeah.
So they might have borrowed money in Japanese yen, because that was seen as a double cumulative effect, i.e. I can borrow for a low amount and I can take a play on the currency. Then they've maybe invested in dollars, and they're either in the world stock market or the US stock market, or they've got an even more concentrated than that. So what we've seen at the beginning of August is a very concentrated unwinding of that playing out.
Yeah.
So the people that have speculated and gone, ooh, I need to unwind those positions now. So they've sold out of that to deal with the fact that interest rates might start rising and have started rising in Japan, for instance.
Yeah.
So you then see a strengthening of that currency, so those positions need to unwind. Now, during the summer months, typically July, August, there is less trading generally in the stock market because people are away.
Yeah.
So our clients aren't investing as much, stockbrokers haven't got as much money going in, fund managers are even away, so they're not doing as many trades as they might be doing in a general market condition.
Yeah.
So you have what's called thinner trading days. So you add that into the equation as well as somebody unwinding their positions,
Yeah.
and it becomes a significant period of volatility, or looks like it. And this is all, of course, with the benefit of a month's hindsight, but that is effectively what we've seen. You then had the concerns over, is the US going to have a significant recession easing because more data's come out, and then markets have settled. And the other thing I would add to this point about bear markets is that quite often when you have a period of negative returns, so if you have that period of a bear market of 20% or more, inevitably what follows is a recovery of some kind. And we had exactly that in this period in August, although it was very short and it wasn't really a bear market because it wasn't a 20% drop.
Yeah.
But it was exactly the principle that our mantra is stick with it, buy more or stick with it. And the principle definitely applied there. If you were trying to time the market, you'd have probably got it wrong. Because by the time this had sorted itself out, everything has come back strong. But not only this time have you had the big 6, big 7 in the US stock market recover well, the rest of the market has started to come back with it. So if you'd sold out on the back of the negativity, you'd have missed the subsequent best days since last November.
Really?
Yeah. And we always talk about time in the market rather than timing the market, and this is very much a prime example of that playing out. Stay in the market if you're looking at long-term investments. By all means, if you want to speculate, take a very small amount of your available cash, the money that you can afford to lose, put that on high-risk investments. But the bulk, the core part of your portfolio, in my view, is buy the funds that you want to hold and just sit back and let those returns play through.
Yeah. And I guess one more thing then on bear markets is, say somebody's got an investment in say, I don't know, it could be a fund or it could be a stock. How do people know that it's a bear market, and how do people know that it's a stock that's just on its way down?
So Warren Buffett, who heads up Berkshire Hathaway, always talks about that. This is one of his mantras as well. Be fearful when others are greedy.
Yeah.
Be greedy when others are fearful. So if you look back on just this calendar year, some of the trades that he has made, he sold out some of his positions well before August because he personally felt that some of the individual positions he was holding had got a little bit top heavy. So he's taken some of his profit and then he sat back and waited for the rest of the market to follow suit. So of course what he will have done, and we won't see it until his results come out in a little while, he'll have then gone, right, now's the time for me to come back in.
Yeah.
In terms of whether you know on individual stock level, it's difficult to determine unless you're a specialist or you've read up and you're understanding things like price to earnings ratios, the amount of capital that a company has relative to their debt. So unless you've soaked up all that information, you won't know whether it's an individual company falling is just a consequence of that sector, or whether there's something else at play.
Yeah.
So if you're not of an understanding down to an individual stock level, you're better off buying a fund anyway.
Yeah.
Because you're allowing an index or a fund manager to then take those decisions or make those decisions on your behalf to better play out how things might work.
Yeah.
In terms of long-term investing, the larger companies, the medium and largest sized companies, if you're buying and holding, they should sort themselves out over a longer period of time. You'll benefit from dividends or share buybacks, adding to the return as well as the share price momentum, the share price gains as well. So don't be too concerned about individual stock holdings unless you're playing that game. Look more broadly in terms of your core holding is what I would say.
Yeah.